For this session, we will talk about your accounting for foreign currency translation. So for this particular session, we must learn how to translate a foreign entity financial statement to our reporting currency. Okay, so again, in a foreign currency translation, we have here possibly two financial statements. So for example, we have here a Philippine financial statement. So our reporting currency is the Philippine peso. And then we have a foreign financial statement. Of course, that foreign financial statement has a foreign currency. Now, this foreign financial statement will be translated to our reporting currency or our presentation currency, which is the Philippine peso. Now, what do we call this foreign currency financial statement or that financial statement that is presented by a foreign currency? We call it as a foreign operation. So what is a foreign operation again? That is a subsidiary as the shape, joint venture, or a branch of a reporting entity, the activities of which are based or conducted in a country or currency other than those of the reporting entity. So in our example, we have here our reporting entity. Our presentation currency is Philippine peso. And then we have a foreign entity. Now that foreign entity, the presentation is a foreign currency. So the main accounting issue here is how will we translate that foreign currency financial statement? Now, in translating your foreign currency financial statements, we need to look whether we should account for it under PAS 21, you're accounting for foreign exchange rates, or PAS 29. So when do we place it under PAS 21 and when do we place it under PAS 29? We place it under PAS 21 if ever that foreign entity or that foreign operation is non-hyperinflationary. So what we need to look here is whether that particular foreign operation is hyperinflationary or non-hyperinflationary. So we use PAS 21 if it's non-hyperinflationary. And we use PAS 29 if it is hyperinflationary. Sir, how would we know if ever that particular financial statement that we are to translate is hyperinflationary or non-hyperinflationary? So in accounting, normally your problems will tell you whether that foreign operation is hyperinflationary or non-hyperinflationary. So take note, what we test here is the foreign operation, whether it is hyperinflationary or non-hyperinflationary. Now, once we know it is non-hyperinflationary, what do we use? PAS 21. And under PAS 21, it provides you closing rate method. It provides you closing rate method. So normally, PAS 21 provides for closing rate method. However, some problems it still use temporal method. So the general rule, what do we use? Closing rate method. But if not, then we use temporal method. So the problem will always state that. But if it's hyperinflationary, we use restatement method. So let's take a look now with your non-hyperinflationary translation of foreign operation. So let's start first with non-hyper. So we said under your non-hyperinflationary, we have two methods. That is either closing rate method or temporal method. So how do we go about your non-hyperinflationary closing rate method? Okay. So under closing rate method, the assets, so whatever is the book value of the assets, you multiply it to your closing rate. So you already know what is the closing rate. That is the rate at the date of your financial statements or your reporting rate. Next, the book value of your liability is multiplied to your closing rate. Paid up capital historical rate. Sir, what is the historical rate? The historical rate is the rate at the time of issue. Okay? So whatever is the time of issue of that uh, particular paid up capital, so our shareholders' equity, That is our historical rate. Then we have your earned capital. It is translated. Sir, how do we compute for your translated earned capital? So for translated earned capital, that is your retained earnings beginning as translated last year. So the beginning translated plus your translated net income or net loss. Sir, how do we compute for your translated net income or net loss? Normally, we use your average rate or your spot exchange rate. Sir, why average rate? Because normally your income is a series of different transactions. So for your different income or your profit or your sales, you have different transactions during the year. Therefore, it's very hard for us to know each rate per day. So for example, every day you have 10 sales and we have 365 days in a year. So if we use spot exchange rate every time we have a sale, that will be too much work for us. So what we normally do is we use the average rate only. So the average rate during the year, we use it to translate our net income or net loss. But if we can specifically again look into the rate at the time of transaction, we use your spot exchange rate. Okay? So general rule, translated net income or net loss is using average rate. Then we deduct any translated dividends. So how do we compute for your translated dividends? Your translated dividends is computed based on your rate at the date of your dividends at at the time it is issued or at the time there is a declaration of that dividend. Okay, so your dividends at the date of its declaration. After that, we can already compute for our earned capital. Earned capital, again, how do we compute? We have your retained earnings beginning as translated. So the previous year translated retained earnings. You add the translated net income or net loss that is based on your average rate. If we cannot, if ever we can specifically look into the rate at the time of transaction, we use your spot exchange rate. Translated dividends at the time it is declared. Okay, so closing rate method, asset closing rate, liability closing rate, paid up capital historical rate, earned capital translated. Now the difference, if ever, because asset is equal to liabilities plus equity, the difference is recognized in other comprehensive income. It will be recognized in other comprehensive income. Okay, next. We use your temporal method. For temporal method, we just need to look whether the asset is monetary or non-monetary. So if it's monetary, closing rate, non-monetary, historical rate. You already know what is monetary and non-monetary, di ba? We have already discussed in the previous topic what is money and non-money. Money, these are fixed amounts normally. These are your receivables, your payables, your cash, those are money. Non-money examples are your PPE, your land, your shareholders' equity, your capital stocks. Those are non-money items. Okay? So, what's the difference between closing rate and temporal? Only in your asset, wherein your asset monetary and non-monetary, they are classified under temporal. But in your closing rate, we do not classify them. Okay? Take note, any difference, because again, once we translate it, we place it in our equation. Asset is equal to liabilities plus equity. So if there is a difference, whether here or here, then we place it in your other comprehensive income as a gain or as a loss. So for example, here we examine between temporal and closing rate method. So again, what's the difference? In your closing rate method, everything is a closing rate for asset, while for temporal, money is closing rate, non-money is historical rate. Okay, so we have here different assets: accounts receivable, trademark, and PPE. Receivable is money, trademark and PPE is non-money. So under closing rate method, we use all the closing rates. So we just get the closing rate, 850 for AR, 600,000 for trademark, and 1.2 million for PPE, 2,650,000 pesos. While for temporal, for money, we use the closing rate, 850,000. And then for non-money, we use the historical rate, 575,000 and 900,000. So 850 plus 575 plus 900,000, we will get 2,325,000. 2,325,000. Okay? So again, all are different between closing rate and temporal except for asset. For asset, closing rate method, closing rate. For temporal, we look for money, non-money. Money, closing rate, non-money, historical rate. Liabilities, both at closing rate. Paid in capital at historical rate. And for earned capital, it is based on your translated using the rule that your beginning RE should be at its initial translated amount. And then we have your net income or net loss at average rate or spot exchange rate. And then less your dividends at the rate at the time it is declared. At the rate it is declared. Okay, let's have a comprehensive example wherein we need to compute for everything. We now translate a foreign financial statement. So Brown Corporation acquired 100% common stock of Red Corporation on January 1, 2019. The following accounts from Red Corporation's adjusted trial in dollars at December 31, 2019 are as follows. Okay, so it is at dollar. The relevant exchange rate in Philippine pesos for $1 are as follows. March 1, average exchange rate. Date the dividends are declared. Date the dividends are paid, the closing rate. The Philippine equivalent of the retained earnings beginning amounted to 392,000 pesos. Assume all income statement items are incurred evenly throughout the year and it is not hyperinflationary. Okay, so as I told you, problems will tell you whether it is hyper or non-hyperinflationary. So this is non-hyperinflationary. The first question is we need to compute for the amount of our net income. So to compute for the amount of our net income, we have here your sales. We have 10,000 pesos. And then we have your cost of sales. We have $4,000 sales, cost of sales, $4,000. Depreciation, $800. And then we have your operating expenses, $2,700. So how much is our net income? So 10,000 plus 10,000 less 4,000 less 800 less 2,700 will give us 2,500. 2,500. And after that, we just multiply it to your average rate. Remember, net income or net loss should be translated at average rate unless specifically a particular expense can be computed using spot exchange rate. In this case, all are average rate. So what is our average rate? It's 52. So 2,500 times 52, what is our translated net income? This is 130,000 pesos. 130,000 pesos. Next question, our translated dividends. So how much is our translated dividends? So first, we need to compute for our dividends. So dividends is at 500. Dividends is at $500. And we compute now the translated dividends by using the rate at the time the dividend is declared. So date the dividends are declared, we have here 53 times your exchange rate, 53. So what is our translated dividends? 500 times 53 is 26,500. So our answer for translated dividends, 26,500. Next, RE end. To compute for our RE end, how do we compute it again? First, we get for our beginning RE. So RE beginning as translated. So how much is our RE beginning as translated? 392,000. Then we add your translated net income, 130,000, less your translated dividend, 26,500. Our RE ending is equal to 392,000 plus 130,000 less 26,500. We have 495,500. So our answer in RE end, 495,500. Next, total assets. So for total assets, we just need to compute for assets multiplied by our closing rate. So first, we get for our total assets. Our assets are cash, AR, and equipment at net. So cash, AR, and equipment at net. So 10,000, 20,000, and 12,000. This is equal to $42,000. So this is your total assets multiplied by our closing rate. Because we are using closing rate method, use the closing rate. Our closing rate is 55. 42,000 times 55 is 2,310,000. 2,310,000. This is your translated assets. So our answer is 2,310,000. Next, translated liabilities end. So to get for translated liabilities, our translated liability is equal to, first we have here your accounts payable, and then we have your unearned rent. Our accounts payable is $8,000. Our unearned rent is 4,000. So our total liabilities is 12,000. You multiply it again with your closing rate. Okay? So our closing rate is 55. 12,000 times 55, our translated liabilities is equal to 660,000. Next, we compute for your translation reserve and your shareholders' equity end. Okay, so first we compute for our shareholders' equity. So for our shareholders' equity, our capital stock should be translated using our uh, what do we call this one? Our historical rate. So our capital stock, it was issued at 50. So capital stock at 50, 50 times 20,000. We have here 1 million plus retained earnings ending. Our retained earnings ending is 495,500. So our translated shareholders equity is equal to 1 million plus 495,500, 1,495,500. So that is our translated sheet. 1,495,500. So our translation reserve asset is equal to liabilities plus equity. So our asset is equal to 2,310,000. our liabilities and equity. So our liabilities, it was translated at 660 and equity is 1,495,500. So how much is our asset? Our asset is still 2,310,000. Our liabilities and equity, 1,495,500. The 660,000, we have 2,155,500. So our credit is lesser. If credit is lesser, we have a gain. If debit, ang kulang naman, we have a loss. So in this case, we have a gain. So how much is our gain? 2,310,000, 2,310,000 less 2,155,500. How much is our translation reserve? So 2,310,000 less 2,155,500. Our translation reserve is 154,500. 154,500. Okay? Easy, right? We just need to know the different rates to be used when you translate it. Okay, so let's have a quick recap on how we translate this one. Assets will be translated at closing rate. Liabilities will be translated at closing rate, plus paid in capital, which will be translated at your historical rate. So this one, historical rate, plus your retained earnings ending, which will be translated as follows. So your beginning as translated, your net income at average rate, or spot exchange rate if ever it can be noted that at a particular date we know the rate of that particular expense or income. And then your dividends should be translated at the spot rate during the date of declaration. Okay? And the difference will be placed in OCI. What do we call the difference again? The 154,500 is known as your translation reserve. Once you get this whole idea, it will be easier for you to answer problems relating to foreign currency translation. Yan lang naman siya. Pag alam mo na lahat yan, madali lang yan. Okay? Huwag nyo rin kalimutan na pwede siyang i-translate using closing rate method and temporal method. Ano lang pagkakaiba nila? Sa temporal method, we classify the item as monetary or non-monetary. Pag monetary siya, at closing rate. Non-monetary, historical rate. Yun lang yung kailangan yung alamin dyan sa non-hyperinflationary. Okay? So how about if ever our foreign currency financial statement is hyperinflationary? So how do we account for it? So in accounting for hyperinflationary under PAS 29, we said we use your restatement method. Okay. So how do we restate? We only restate non-monetary items. We only restate non-monetary items to their GPI. Monetary items are not restated. So if that is non-money, restate. Money, no restate. Next, you multiply it all to your closing rate and take note, the exchange differences now is accounted under profit or loss. Non-hyper, where do we place your exchange differences? In OCI. Hyper, where do we place it? In your profit or loss. Take note of that. Non-hyper in OCI, hyper profit or loss. Isa lang naman yung bago dito, madali nga lang siya. Pag non-money, you restate it, multiply it to your closing rate. Pag money, do not restate, multiply it to your closing rate. Okay? So how do we restate? So if ever we have your non-money, you get the book value, you multiply it to your GPI or your general price index and divided by GPI at acquisition. So whatever is the acquisition date of that particular non-money, we use it. So for example, We have here cash, we have here AR, and we have here land, and we have here building. Okay. So in dollars siya, 10,000, 2,000, 4,000, and 5,000. The building is at net. So our GPI at end is 520. So our GPI at end is 520. The GPI at January 1, 2018, the date of purchase of land is 120. And the GPI at 1/1/19, date of acquisition of building is 180. The closing rate is 52. Okay? So madali lang. First, we know the non-money. You restate it. Money, do not restate. So let's answer this problem by knowing the items that are money and non-money. Cash is money, AR is money, land is non-money, building is non-money. Okay. So after determining, we list it down, cash, AR, land, and your building. We get the book value, 10,000, 2,000, 4,000, 5,000. First step, you restate the financial statements. Non-money are restated. How do we restate your non-money? Non-money book value multiplied by the GPI end. So what is the GPI end for our example? 520. You divide it to the GPI at acquisition date, so land. So land, the GPI is 120. So what is the translated? 4,000 multiplied by 520 over 120. Our translated is 17,333.33. How about building? Building is non-money, di ba? Sabi kasi natin, pag non-money, i-restate natin. How do we restate again? You get the GPI end. What is our GPI end? Given 520. You divide it to your GPI at acquisition date. So what is the GPI acquisition date of our building? So building GPI is 180. So let's compute for the restated. 5,000 multiplied by 520 over 180. We have here 14,444.44. So non-money are restated. Next step, money are not restated. So we just get the value 10,000 and 20,000. After that, we translate all accounts at closing rate. So what is our closing rate? 52. So what then is our translated asset? So 10,000 times 52, the translated cash is 520. Translated AR, 20,000 times 52, we have 1,040,000. Translated land, 17,333.33 times 52, we have 901,333.16. And then translated building, 14,444.44 times 52, we have here 751,110.88. How much is our total assets translated? 901,333.16 plus 1,040,000 that's 520,000. We have 3,212,444.04. Okay, so that's how we translate your hyperinflationary. First step, you restate non-money. Do not restate money. How to restate GPIN divided by GPI at acquisition date. Next, you translate all accounts using closing rate. So our closing rate in our example, 52, so we multiply it at 52. Next, and exchange difference are recognized in profit or loss. So take note, profit or loss pag hyper, if non-hyper, saan ilalagay? OCI. Anong standard pagka non-hyper, past 21? Pag hyper, past 29. Okay. So under PAS 29, it provides also for the characteristics of hyperinflationary economy. So how do we compute for your characteristics of a hyperinflationary economy? So when can we say it is hyperinflationary economy? When can we say it is hyperinflationary economy? We can say it is hyperinflationary economy if ever the cumulative inflation rate over 3 years exceeds 100%. Cumulative inflation rate exceeds 100% for the 3 years. So, sir, how do we compute for that particular inflation rate? To compute for our inflation rate, that is equal to our ending inflation rate divided by beginning inflation rate. So, the earliest period. So how do we compute? Let's make use of this example. Lava has a foreign subsidiary located in country experiencing high rates of inflation. Information concerning this country's inflation rate experience is given below. So how do we compute for your inflation rate? So first we get for your ending inflation rate. So our ending is 210. You compute for the change on that ending inflation rate. 210 less the beginning, 90. We have here 120 inflation rate. This is now the cumulative for the 3 years change. Diba? So ending inflation rate based on the change is 120 cumulative. You divide it to your beginning inflation rate, 90. So 120 divided by 90, our inflation rate now is equal to 133.33%. So is it hyperinflationary? Yes, because the cumulative rate for the last 3 years, 1 year, second year, third year, exceeds 100%. 210 less 90, our cumulative change is 120, divide by the beginning 90, 133.33. So it is hyperinflationary. So when do we determine it is hyperinflationary? If ever the cumulative change exceeds or approaches 100%. But for problem solving purposes, the problem will always tell you whether it is hyperinflationary or non-hyperinflationary. So let's recap everything that we have learned under your translation of foreign operation. So how do we translate? Depending whether it is hyperinflationary or non-hyperinflationary. If it's hyperinflationary, we use past 29. If non-hyper, we use past 21. So under hyper, we use your restatement method. So money items, you just multiply it to your closing rate. Non-money items, you multiply it to your restatement multiplied by closing rate. How do we restate? We get for the GPI, the price index at the end, divided by the GPI at the acquisition of that particular non-money. For non-hyper, the general rule is we use your closing rate method. For as an exception to this rule, we use your temporal method. And take note, exchange differences under non-hyper is placed in OCI. For hyper, we place it under profit or loss. Okay? So that's it for our translation of foreign operation or foreign financial statement.